See, today we will be taking up on to departmental accounting. So page number 1 in this PPT, it has got in the trial balance capital account of 40,000, drawings of 1,500, and opening stock they given for department A, B, and C. Purchases similarly. Sales for all the 3 departments given. Sales returns by and carriage provider. Furniture and fixtures, plant and machinery, motor vehicles, and data studies. Salaries, power and water, telephone charges, bad debts, rent and taxes, insurance 1,500, wages for 3 departments, printing and stationaries, advertising, bank overdraft, and cash in, and all put together. The trial balance is agreeing at 1,75,000. You are required to prepare departmental training, profit and loss from the balance sheet. Take into account the following adjustments: outstanding wages for B and C. Depreciate plant and machinery, motor vehicle at the rate of 10%. Each department shall share all expenses in proportion to their sales. Closing stock of the 3 departments here mentioned. How do we accommodate, or how do we prepare these accounts? So we all know that a trading account is how it will look like. In a columnar form, we are expected to prepare the opening stock, purchases, wages, and sales and closing stock. The respective returns are to be deducted. Sales returns shall be deducted. So that way we can arrive at gross profit as a balancing figure. Sales figures given, with closing stock also given, opening stock, purchase price, and all that breakup they have provided. Wages outstanding also we are expected to take into account. Then the preparation of profit and loss account would result where the gross profit, as we have done in the case of trading account, as we know that the expenses are to be shared between the 3 departments based on the sales ratio what they have given as 5:3:2. 5:3:2 is the ratio that we have adopted for all the items. But it resulted in net profit for A and C, and which resulted in a marginal net loss in the case of B. So now, when we prepare a balance sheet, we are expected to add those. There is net profit and net loss together with drawings deducted, and 78,650, a very simple problem to handle. So all expenses have been allocated among the department in proportion to the sales and solution as per the requirement of the question. So quite naturally, the question did carry the direction as how it is to be handled, and it got handled. So in my opinion, it's a very simple question with no question number 2. So here is a place where we can spend some more time. So what is that? X sells to Y at a profit of 40% on cost, and to Z 20% of cost. Y sells to X and Z at 25% and 15% of sales. Z charges 30% profit on cost to X and 40% on sale to Y. Stocks lying at different departments at the end of the period. So from which place these items have just come, calculate the unrealized profit. So in fact, understanding should be proper, and therefore I will shift my focus from this PPT or PDF to screen that I will share, where I will note down. We have X, Y, and Z. So what they mentioned is X to Y. cost plus 50%. Z cost plus 20%. Y to X this is 25% on sales. Y to Z 14%. Z 30% figures. Cost plus 30%. And 40% is on sale. So 40% is on sales. So this is first diagram. Working on number 2. So in X, in Y, and Z. From X, from Y, and from Z. 75,000. So cost plus 50%. So 1/2 on cost equal to 1/3 on selling price. $40,000. 48,000. 48,000. Cost plus 20% is equal to 1/6 on selling price. 1/6 on selling price into 1/6 on selling price, which is equal to 8,000. Then so what X is having from Y is 50,000. So what X is having from Y department is 24. $12,500. Dash dash. Here from Y Z. From Y Z 14%. $12,300. $52,000 into, so it is or 30/130 on selling price. 30/130 on selling price. 52,000 divided by 130 into 30 is equal to 12,000. Next, from Z to Y, 56,000. 56,000 into 40%. I do 400. So profit made by X not realized. Total comes to 33,000, 24,800, and 34,400. Now let us just know about what exactly is the thing that we have. $92,200. That's it. 33,000, 24,800, 34,400. That's it. ABC Limited has several departments. Goods supplied to each department are debited to memorandum department with stock account cost plus fixed percentage markup. To give the normal selling price, the amount of markup is credited to departmental markup account. If the selling price of the goods is reduced below its normal selling price, the reduction markdown will require adjustment both in stock and markup account. The markup for department X for the last 3 years being 20%. Because relevant code X for the ending 31st of March 19 were as follows. So opening stock purchases and sales 6,40,000. It is further ascertained that shortage of stock found in the year ending 31/3/19 costing rupees 4,000 was written off. What is that? Shortage of stock found costing 4,000 was written off. This accidental loss. Opening stock including goods costing 12,000 has been sold during the period, has been marked down in the selling price by 1,600. Say maybe it may be a slow moving, or maybe it would have attained some defect, or it may be an obsolete stock they want to reduce and sell it off. So that way the remaining stock was also sold during the current period. Goods purchased during the period were marked down by 3,600 from a cost of 30,000. Marked down costing 10,000 remaining unsold. So out of 10,000, 30,000, 10,000 is remaining. So therefore, proportionately marked down from 3,600, you got to take it up for 1,400 on pro rata basis. You got to do. So the departmental closing stock is to be valued at cost, subject to adjustment for markup and markup. You are required to prepare departmental trading for yes for the ending 31st of March 2019. So the head office memorandum stock, then memorandum markup account for the year. See now, we are expected to operate. So how will it get operated? So we are expected to prepare trading account at cost to opening stock 1,50,000 to purchases 4,30,000 by sales 6,50,000. Then they have mentioned about the rate of markup. So what is the rate of markup? Cost plus fixed percentage. So this figure of 6,50,000 is not at the normal price. So therefore, to gross profit, we have got to work. Wow. So separate working note that we got to develop. Had it been a normal selling price, the amount of markup is given in the last slide. They have mentioned it as 20%. So with that 20% on the sales figure, whatever markdown that you have made, that you have to deduct both in, that you should deduct in gross profit, arrive at this figure of gross profit, and closing stock shall be the balancing figure. So they have not given us the this thing by shortage of stock also. They have just mentioned 4,000. We are expected to. They have mentioned here it should be valued at cost subject to adjustment for markup and markdown. Now let us just look at the question, the resolution. So this is what I was just telling you now. So opening stock plus purchases. Closing stock was not given as a problem. That has got to be worked out. So that has got to be worked out. How it has got worked out? See, actually, ideally speaking, this memorandum stock account should have come in the next slide. That would be better. So there, this 36,000 was considered to be closing stock at inflated price. We are expected to reduce that markup. You can just see the markup account you will be getting. One moment, say there is some problem there with my computer. It is not responding. Close the program. The closing stock that you've seen as 36,000, here it is 31,000. In markdown, you will be having exactly that 5,000. So that would be coming up. And with that solution is coming to an end. This is what I was just telling you, proportionate basis we have to work out. Cost of sales, how it is worked out. To the sales figure, you got to add markdown. And during the current purchase also something that you got to mark down. So had there been no markdown, it would have been 6,54,000, 20% on cost or 1/6 on selling price. You can work out, and cost of sales is worked out, and closing stock is worked out, and only then you will be in a position to take a complete work. So now, to some extent, I think we can accommodate this in our separate working. So here they mentioned it as cost plus 20%. So this is question number 3. So you can arrive at the trading account. One moment. In stock, to purchases, to gross profit, by sales, by normal loss, by closing stock. So shortage of stock costing 4,000. $150, 4,30,000. Sales figure of 6,50,000. Okay. Opening stock including goods costing 16,000 has been sold, has been marked down by 1,600. The remaining stocks were sold during the current period. Is what they mentioned. What is this? So we find the sales figure is 6,50,000, which is a reduced figure, reduced by markdown. So add those markdown from opening stock 1600. As I told you that it may be a defective stock, it may be obsolete stock. There can be a variety of reasons as why they give discount. So remaining stock has been sold during the year. That means no portion of the opening stock is there and all stocks were sold. Goods purchased were marked down by 3,600 from the cost of 30,000. Marked down stock costing 10,000. Remaining, that means out of the purchases, 2,400 we have added from current period purchases. 2,400. How come? Here they mentioned 3,600 as a markdown. So when cost is this much, markdown. When it is 30,000, 3,600. So 10,000 unsold. That means 20,000 sold. What is the corresponding markdown? So 3,600 divided by 30,000 multiplied by 20,000. That is the one that you have. So department closing stock is valued subject to adjustment for markup and markup. That is what they mentioned. So it is 6,54,000. The normal. Then we all know that our gross profit is going to be 20% on cost. So 1/6 on 6,54,000. 6,54,000 divided by 6. So it is going to be 1,09,000. Correct. Then all this markdown not realized. This is by 4,000. So 4,000 we are expected to deduct. So gross profit is 1,05,000. Is 31,000 balance. Trading account is over. First part of the question over. Department trading account. So memorandum stock account and memorandum markup account. Are you clear about this trading account? Harish? So now let me just take up memorandum stock account, memorandum markup. So to balance per account, opening stock. How much is the opening stock? 1,50,000. See, I would like to develop it in this fashion. Cost and cost and so actually this is very important. Cost is only to track. To balance per account 1,50,000. So what is the rate of markup? The rate of markup is 20% on cost. So here it is going to be 1,50,000 plus 20% minus. What is the markdown that you have? So to the extent of 1,600. 1,600. Take the calculator. 1,50,000 into 1.2 minus 1,600. It is 178,400 by balance brought down minus 1,50,000. 28,400. Correct. Then two purchases. Two purchases. 4,30,000. 4,30,000. 4,30,000 plus 20% on that. 3,600. 4,30,000 minus 3,600. 512,400. 512,400 minus 4,30,000 is by purchases 82,400 by abnormal loss. Costing 12,000 they lost. 12,000. 14,400 to abnormal loss 2,400 by sales 6,50,000. To balance carry down. What is this balance carry down? So your closing stock $31,000. From where we have bought? From here we have bought. So 31,000 plus 20% minus 1,200. 1.2 minus 1,000. 6,200. 31,000. 5,200. Right. So either you can write it in full and go for markdown, or you can adjust in the item and you can do it. Now let us just know about the markup account. 28,400 plus 82,400 minus 2,400 minus 5,200. It comes to 103,200. Now let us just find out 178,400 plus 512,400 minus 14,400 minus 6,40,000 minus. Okay. Now let us see how the markup account is taken up. Yes. So you would have seen 5,16,000 and then markdown is on the opposite side. For shortage, we have just taken up 6,40 and say 1,000 to 1.2 minus 1,200. 36,000 is. So you just see 30,000, whereas here we have taken up 28,400 because we are taking up opening stock also. So we are bringing out all those adjustments, and finally 105,000 will be the final answer. 28,400 plus 82,400 minus 2,400 minus 5,200. So 1,800, there is one item we do have. Yes, I'll tell you what they have just done. See, for every item that we accommodate, so 1,50,000, add to that 20%, it comes to 30,000 rupees. And 1,600 rupees we have adjusted. So here what they do is that it can be accommodated and 1,600 we have adjusted. So either you can put full value and show it as a reduction, or you can deduct it directly. Okay, profit and loss account 4,000. Cost of shortage. Cost of shortage we are not done. So I think I've just taken a wrong figure. It's 4,000 only. $4,000, and it is 4,000 into 4,800. Sorry, 800 is. Now I think it will be correct. 28,400 plus 82,400 minus 800 minus 5,000. So 4,000 and 800. Okay. Then current purchases minus 3,600. That is what you find. 3,600 we have found. Data 6,50,000. 6,50,000. 36,000, and it will automatically agree. Now let us just find out. 178,400 plus 5,400 minus 4,800 minus 6,50,000 is 36,000. It will automatically agree. So it is 5,80,000. It is 800 0 9 6 90 800. It will automatically agree. This is only for the purpose of finding out. This is cost of sales. Correct? This we have already got. Cost of sales we have already got. One can easily work out that. So 1,50,000 plus 4,30,000 minus 4,000 minus 31%. So 5,45,000. 5,45,000. So it will automatically agree. Now you just find the gross profit of 1,05,000 worked out here. So the difference between the two is accommodated 28,500. The difference between the two is accommodated here. The difference between the two is accommodated here. The difference between the two we have accommodated here. So this 5,000 only. Extra, sorry. So now let us just find out 800, 0, and 11. 1,800. It will automatically do. So the way of presentation may be different. So here all markup and here markdown. Whereas what I've done is that markdown is also reduced. Please just don't worry, they will award full marks. So question number, okay. Below balances are taken from the records of big shopping complex for the ending 31st of March. Opening stock purchases sales for both P and Q. Closing stock of P was 2 lakhs, including goods transferred from Q. Closing stock of Q was 4 lakhs, including goods transferred from P, 60,000. Opening stock of P included goods for 20,000 transferred from Q. And opening stock of Q included goods for 30,000 from P. Assume the above transfers are at cost to the transferee. Not transfer, transferee. And the rate of gross profit is uniform for year to year. Total selling expenses 2,40,000 for both the departments. From the above information, prepare a departmental trading account and profit and loss account for the ending 31st of March after adjusting unrealized profit if any. See, leave that inter-departmental transfers. So closing stock of P was 2 lakhs of Q as 4 lakhs. Now with the help of calculator itself, we can type it out. 1 lakh plus 13 lakhs minus closing stock of 2 lakhs should give you 12 lakhs as cost of goods sold, against which 20 lakhs we have as the sales, 8 lakhs as the profit. 8 lakhs divided by 20 lakhs, percentage is 40%. So we understand that it is 40% for P. Let's take up for Q. 80,000 plus 18 lakhs 20,000 minus 4 lakhs 14 lakhs minus 30 lakhs. We understand that this 14 lakhs as the profit divided by 30 lakhs will give you 50% gross profit. So we understand 40% in the case of P, 50% in the case of Q. So closing stock they have referred, opening stock they have referred. It's a fairly very simple question. Question number 4. Department P and Q. Opening stock plus purchases minus closing stock is equal to cost of goods sold. Sales, gross profit rate. Opening stock 100, 1,300, and 200, and 1,200, sales 2,000, and it is 800. Rate of gross profit 40%. These are all rupees in thousands. Here it is 80, 1820. Closing stock 400, 3,000, sorry, 1,500, 3,000, 1,400, and 40%. Correct. So this is working out number 1. Working out number 2. We have opening stock and closing stock of P and Q. So opening stock of P includes 20,000 from Q. 20,000. Opening stock of Q includes 30,000 from P. 30,000. Q's stock is stock. In closing stock, we have P has got Q stock 40,000. Q stock, and it is 60,000 is stock. That means incremental stock is 20,000 and 30,000. The rate of markup is 50% because it is Q's stock in P. Hence, Q's GP rate. So unrealized profit is 50% on this 10,000. Here it is 40%, 12,000, so 22,000. So departmental trading account, P&L account, and total selling price 250,000. So gross profit is 2,300, unrealized profit 22. So without even preparing departmental profit and loss, there is a columnar form we can complete. So profit and loss account, GP of P, GP of P and Q, 2,300. Then unrealized, then you have selling expenses 250. Selling expenses, unrealized profit 22. 2,300 minus 250 minus 22. 2028. 2028. Just see. That's why very easy. If you understand the flow, it becomes simple. Question number 5. One moment. XYZ garage consists of 3 departments: spares, services, and repairs. Each department being managed by a departmental manager, whose commission was respectively 5, 10, and 10% of the respective departmental profit, subject to a minimum of 5,000 in each case. Interdepartmental transfers take place at a loaded price from spare to service 5%, from spares to repairs 10%, from spares to service. I think there is a mistake. Because 5%, 10%, now it can be have same. Maybe we will just wait for that. In respect for the ending 31st of March 2019, the firm has already prepared and closed the departmental trading and profit and loss account. Subsequently, it was discovered that the closing stock of department has included interdepartmentally transferred at a loaded price instead of the correct cost price. Loaded price would mean the profit will have unrealized profit to it. So we are expected to eliminate that and then calculate the commission. That is the crux of the issue. From the following, you are required to prepare a statement recomputing the departmental profit. So we have 3 departments: spares, service, and repairs. So after charging commission, 38,000 loss, 50,400 profit, and 72,000 profit. Interdepartmental transfer included at loaded prices. So 65,000, 21,000 from spares and 44,000 from repairs, and it is 4,202. I'm not very sure about this number. So now let us just bring out the solution. See, when they are given 38,000, 50,000, 470,000, this is after charging commission. Before charging commission, where it is 10%, on after it is 1/9. So, and 1/9 when you do, and they also understood that there is a minimum amount that you have to work out, that being 5,000. See, when a department is reporting loss, how do you expect them to charge commission? So therefore 5,000 they would have paid. That is what we understand. So here 50,400 divided by 9, which is normally expected to be greater than 5,000, 5,600 in this. So before that, it would have been 33,000, 56,000, and 80,000. Right. Unrealized profit on stock 1382. So here is a place where they have just brought the information regarding unrealized profit working note number 2, which is coming up later. So as how we have just done from profit spares to repairs. So 4202, that I was just telling you, no, from the previous case, previous slide. So that they mentioned interdepartmental transfers. On that only we are expected to apply. Right. So unrealized profit when you deduct. So quite naturally, this an appropriate base to calculate the commission. So since this department is spares department is reporting loss, 5,000 has got to be taken up. So on 56,000 apply 5,600 and 50,400, 76,000 10%, 7,600, and correct profit for managers after managers commission is 68,400. So this is the way this particular problem has got to be completed.